Today we're talking about how investors are trading the stock market during the Iran conflict and whether this volatility is creating opportunity. After the weekend strikes on Iran, the CNBC Investment Committee debated what investors should actually be doing with their portfolios right now. One comment stood out in particular. They said the big wave is yet to come. So what does that really mean for stocks? In this video, I'm going to show you the clip from CNBC, and then I'll break down exactly what was said and what I think it means for the market moving forward. After that, I'll walk you through 3 oversold stocks that I believe are setting up for a potential comeback. Make sure you hit the like button, share the video, and drop your thoughts in the comments. And if you're serious about investing, subscribe so you do not miss the next important market update. Now let's get into the clip.
Take a look at, Joe, what's a very, very interesting market day as we've turned a bit. NASDAQ is now green, as is the Russell. So the Dow and the S&P obviously are well off their worst levels, and we're watching a number of different asset classes, from oil, of course, to the metals, et cetera. What are your thoughts here?
So I think you have to ask, what is the message in the price action that we're seeing today? And I truly believe that the market did a very efficient job in pricing in a premium over the last month for energy prices and for bonds, and for whatever reason, certainly equities were discounted over the last month. So that puts you in a position today where what could be perceived as a significant geopolitical shock that acts as a catalyst for a precipitous decline in risk assets is not unfolding, and we're kind of just back to where we were last week, understanding where the opportunities potentially might exist in the marketplace. I also think it's interesting that it is the Mag 7 that once again are coming to the rescue on a day like today. It is Apple, it is Nvidia moving higher, it's Microsoft, it's Alphabet. So if there is ultimately an equity safe haven, those names once again prove themselves to be exactly that.
The commentary, Mike Santoya, I'll come to you here just to lean on you for a moment, seems to be anything from briefly the markets will react, a geopolitical shock. You point out today in your original pitch of the day that these tend to be short-lived. Yes. In terms of a market impact.
And I think everybody had 2 days to sort of absorb the history of this, and it's eventually, and often not very long after the event, a buying opportunity. Nobody even allowed much of a dip to occur this morning before essentially buying it. I always try to ask, what do you think the market ought to reprice in the response to this kind of event? Brent crude going back to levels we saw last June was probably not going to radically alter the picture. As Joe mentioned, we have been sort of clenching up in advance of this. You had a 21 VIX going into the weekend when the S&P's been flattish. I do think it's, though, instructive to kind of see how the market's doing it today. More stocks are down than up. You actually have a mix of the sort of counter trend rallies in some mega cap tech, along with beaten up software and credit-sensitive investment banks, along with the usual energy going up, defense stocks going up. So the market's doing what it's been doing for a very long time, which is selling one thing to buy another, and essentially rotating away from danger and keeping us in the range. So I don't think we have any kind of an all clear based on the issues we've been grappling with for a few weeks, but you also saw not much of an exacerbating factor coming from what happened over the weekend.
The new variable, of course, is energy, which is being discussed as well. As you see, Steph, both Brent and WTI rise substantially today. Wells Fargo declares the worst case scenario for the market would be an S&P 500 falling to 6,000 if, in fact, you do have a significant oil shock. If you have a prolonged closure, they talk about, of the Strait of Hormuz, that you could see oil above $100+ a barrel. And then, of course, that would mean something more significant for the equity market.
So first, I think it's pretty remarkable that we have thrown so much at this market. Venezuela, SCOTUS, AI, software, banks, the whole thing. And guess what? S&P 500 is flat on the year. And the equal weight is up 6% on the year. And it speaks to a resilient economy, and also speaks to just really strong rotational action that we're seeing in a lot of different groups. And it's and Mike, you mentioned it, that there are a lot of groups that are participating today. There are plenty that aren't, but there are a lot. It's not just Mag 7, it's financials. It is energy, some materials, some software. but that's actually a very healthy sign in my mind. So still have a lot of unknowns. You asked about oil. Watch oil. I actually thought, Scott, that oil was going to be up $10 to $20 today, yesterday at this time, and up almost $5. I mean, of course, oil has rallied 19% year to date in expectations, but if we got another $10 or $20 upside in oil, that would be very problematic. The other interesting note is that the 10-year hit 392 yesterday. It's now at 404. So that's sort of kind of interesting to me, too. Like, we're not seeing a massive panic.
Like the traditional safe haven run to bonds, and then you'd see yields fall. In fact, it's the opposite. Your points are well made.
And I would just say one last thing. Credit spreads. Credit spreads are okay. They're a little elevated, but they're nowhere near COVID, or they're nowhere near Liberation Day. So that, to me, seems like a pretty good outcome. We'll
have more just past the bottom of the hour on the fallout in the energy markets, the whole complex, when Mark Fisher joins us of MBF Trading. He, of course, such a great mind and a famed energy trader across the board. He'll join us with his insights and where he thinks all of that could be heading and how he is trading it. And we'll do that again just after 12:30. You know, Jimmy, I guess a lot of this depends on how long this persists. The president, you just heard, suggests could be 4 to 5 weeks. We have the capability to go longer if we need to. I thought it was interesting that the president told CNN within the last hour that the, quote, big wave is yet to come. So, you know, we're watching all of that, and that in some respects will dictate how these various asset classes move.
Yeah, and that creates a lot of uncertainty. I'm very pleased with how the markets have responded across the board today, whether it's equities, whether it's fixed income. Crude oil is honestly not that bad. Most importantly, the dollar has been stable. I thought that might be a referendum by the rest of the world on U.S. foreign policy, but it's basically flat. But 4 to 5 weeks for a military operation is a long time. This is not an overnight, over the weekend operation in Venezuela. This is not even Operation Midnight Hammer from June of last year. I think it was June. It was the summer when we bombed the nuclear facilities. And a lot can happen. The biggest wild card, I think, Iran is obviously trying to draw regional countries into the fray by attacking Qatar and United Arab Emirates. So far, they have been restrained in their responses, but you don't want to see this become a regional conflict. Right now, it's really just the U.S. and Israel against Iran. All of this being said, you know, we have experience over the last 4 years that really hot conflicts in places like Ukraine, Hamas, Lebanon, that these have not upset consumption here in the U.S. These have not upset capital expenditure plans here in the U.S., whether it's data centers or whether it's manufacturing onshoring. And a somewhat trivial point today, but would have been important if not for the weekend news, is the ISM manufacturing survey is nicely into expansion for the second month in a row, which indicates that there is very good economic strength here in the U.S., unlikely to be upset by the current events unless they get meaningfully worse.
Well, Joe, most are, you know, the commentary I read from this morning is a suggestion not to bail on the story. You know, and the story is that there's enough to build on to keep the market moving higher once you get past the obvious volatility that comes from times of war. Julian Emanuel of Evercore says more earnings plus more volatility equals more upside. Delayed, not derailed. He raises his S&P earnings estimates. There's a couple of notes from Ed Yardeni today that I thought were particularly interesting. We wouldn't be surprised if any sell-off in the morning turns into a rally. That's one thing. And then he also goes further and says in our short war scenario, of course, who knows how long this will progress, oil prices should fall in the coming weeks after a ceasefire, boosting consumer spending, benefiting global economies. The weekend's Middle East developments make us even more confident in our roaring 2020 scenario.
Yeah, I'm a little bit more aligned with what Mike said before, where I don't think you have the all clear here. I think you just get the pass on you don't break down because of a geopolitical shock. I think we continue to have what I characterize it as rotational volatility. That's been the story all year. It's not exit volatility. It's not like people are moving to the sidelines. So I think today it's just, all right, the geopolitical shock presents itself. We don't break down precipitously. You kind of go back to where you were. I don't know if I see us going very far on either side for the S&P 500 of unchanged. I think to Steph's point, the S&P equal weight, yes, that could carry itself higher. That seems to be where the leadership is so far year to date. But I just don't think you want to get too high or low in either direction. I think that's the story so far of this year.
That's because, Mike, you just don't know whether this is 4 to 5 weeks or 4 to 5 months. It's just too early to tell if it's a sustained conflict of that level of magnitude, which is why Barclays today suggests it's simply too early to buy any dip until you get a sense of how long this really could last.
Yeah, and I think that was premised on the idea we might get a little bit more of a messy downside open today and sort of wait for it to settle out. But I agree with that. I think you can go on the premise that the market at this point is building in an expectation that this is not going to be either long-lasting or particularly disruptive, whether through the oil price or trade flows or anything like that. And so therefore, you test the news flow against that assumption, and you assume that the market would have to, adjust if in fact it looks like it's getting worse or the disruption is starting to build on that. So I do agree. I mean, I think it's worth remembering that Friday, and who knows how much of this was anticipation of something over the weekend, it had a real growth scare feel to the market.
Sure.
I mean, it was staples, it was defensives rallying, it was a huge bid in bonds, and you do have parts of the cyclical trade have really fallen away. It's only industrials that are really holding up their end of the bargain. You have a 6-month chart of industrials, consumer discretionary, and financials on an equal weighted basis. That's what you have. You have industrials doing the work right now. It's not like the other ones are completely falling apart, but they're not really carrying the weight to the upside. So maybe that's opportunity, maybe that stuff's gotten cheaper, but I do think even today, you see travel stocks, you see consumer related, you see housing related, not really holding up.
Yeah.
Well, I mean, I want to ask about energy, want to ask about materials. Even if you strip away today because there's an obvious movement, don't you think that there was some positive momentum before today in those sectors as well?
Well, for sure. I just don't read that as principally about the domestic macro story getting better, right? So it's a global reflation trade. There's no doubt about it. We came into the year kind of positioning for that, and I think that was part of it. Plus, every sector that was under-owned and really small within the S&P has received this flood of money coming out of tech. And if you looked at the charts of consumer staples, materials, and energy, it's the same chart. Like, they basically have had the same trajectory of move in the last, month or two. So I think that's why the other dynamic, it's hard to pull apart what the macro story is in energy and materials aside from reflation, commodities, supply, maybe we're going to get disrupted.
We have seen a growth scare.
Right.
The Atlanta Fed tracker was at 5.3%, and it's now at 3%. And it could even go a little bit lower because January was really crummy for retail sales and auto sales. And you can blame it on weather. We'll have to see. So we are seeing a little bit of a growth scare. So it makes a lot of sense. I think, though, that you're going to see a rebound from the first quarter into the second quarter, especially as we get more fiscal policy from the one big, beautiful bill.
So let's unpack what we just heard. The first big theme in the interview is market resilience. Despite geopolitical tensions, rising oil prices, bond yield fluctuations, and uncertainty about how long a potential military conflict could last, the market did not break down. In fact, the Nasdaq turned green, the Russell went green, the Dow and the S&P recovered from earlier losses, and that is important. The speaker makes a key point that the market had already been pricing in risk over the last month. Energy prices had been bid up, bonds had adjusted, equities had been discounted. So when the shock actually hit, there was no panic spiral. That tells you something. The market was not caught off guard. Personally, I think this says a lot about how algorithmic and forward-looking markets have become. In past decades, a geopolitical event like this might have triggered a full-scale panic. Now, it feels like the system stress tests the news in real time. If it does not fundamentally change earnings or growth expectations, investors rotate rather than run. And that word rotation comes up again and again. We are not seeing exit volatility. We are seeing rotational volatility. Money is not fleeing the market. It is shifting inside the market. One of the most important observations in the interview is that the so-called Magnificent Seven came to the rescue again. Companies like Apple, Nvidia, Microsoft, and Alphabet were moving higher on a day that could have easily been risk-off. That is a huge signal. If there is such a thing as an equity safe haven, it appears to be mega-cap tech. Think about that for a second. Not bonds, not gold, not defensive consumer staples. The market is treating dominant AI and platform companies as structural safe havens. And honestly, I agree with that to an extent. These companies have fortress balance sheets, global revenue streams, and in the case of Nvidia, they are at the center of the AI infrastructure build-out. If the economy slows, they still generate cash. If growth accelerates, they benefit even more. However, I do think there is risk in crowding. When everyone hides in the same place, that place can get very crowded very quickly. So while I understand the logic, I would not blindly assume these stocks are immune to valuation compression if macro conditions worsen significantly. The conversation then shifts to oil and energy, which is the real wild card here. There is talk of Brent crude WTI and the possibility that if the Strait of Hormuz were disrupted, oil could spike above $100 per barrel. That would be a game changer. The reason is simple. Oil above 100 is not just an energy story, it is an inflation story, it is a consumer spending story, it is a margin compression story, it feeds into bond yields, it affects Fed policy. One speaker even mentions that if oil had jumped another $10 to $20 immediately, that would have been problematic. But it did not. That matters. What also matters is that the 10-year Treasury yield did not collapse. It actually moved higher. In a classic fear trade, you would see money rush into bonds, pushing yields down. That did not happen. The dollar remained stable. Credit spreads were elevated but nowhere near crisis levels. In other words, no systemic stress. And that brings us to something I found very interesting. Despite everything thrown at the market this year, geopolitical shocks, growth scares, sector rotations, the S&P 500 is roughly flat, and the equal weight index is up about 6%. That is a healthy sign. It means this is not just a narrow rally. Leadership is broadening. Financials, energy, materials, and some software names are participating. That type of rotation is constructive. It shows internal churn rather than structural decay. Now here is where I want to insert my own view. When markets refuse to break, that can mean two things. Either underlying fundamentals are strong, or complacency is building. Right now I lean toward the fundamentals argument. The ISM manufacturing survey is back in expansion. Capital expenditures in data centers and onshoring continue. AI infrastructure spending is not slowing down, but I am also aware that markets often price in best-case scenarios. The assumption right now seems to be that this geopolitical conflict will not be long-lasting or economically disruptive. If that assumption proves wrong, repricing can happen fast. There is also discussion about how long this military situation could persist. 4 to 5 weeks was mentioned, maybe longer, and that uncertainty is key. Markets can handle known risks. They struggle with open-ended timelines. Still, the commentary suggests that past conflicts in places like Ukraine or involving Hamas did not materially derail U.S. consumption or capital spending. That is a powerful point. Domestic economic momentum often overrides overseas turmoil unless it directly hits energy flows or trade. And that ties back to Jensen Huang's broader context, because even though this discussion centers on markets, the underlying current is AI and structural growth. NVIDIA's dominance in AI chips positions it as a core beneficiary of continued data center build-out. Even in volatile macro conditions, companies are not pulling back from AI spending. If anything, they are accelerating. That is why I think NVIDIA keeps getting treated as a safe haven within equities. It is not just hype, it is embedded in the infrastructure of the next computing cycle. The analysts in the discussion also debate whether it is too early to buy dips. Some argue that without clarity on duration, it is premature to aggressively add risk. Others believe earnings growth combined with volatility simply delays upside rather than derails it. I personally think selective buying makes sense, but broad, indiscriminate dip buying can be dangerous if macro assumptions shift. The key is to ask what the market is pricing in. If it is pricing in a short, contained conflict and that proves accurate, dips are opportunities. If the situation escalates regionally and disrupts oil flows, the entire calculus changes. Another fascinating piece was the idea of a global reflation trade. Energy, materials, and underowned sectors have been catching bids partly because money is flowing out of overcrowded tech positions. When sectors are underowned and small in index weight, even modest inflows can drive strong percentage gains. That is mechanical, but powerful. At the same time, parts of the consumer economy like travel, housing, and discretionary spending have not been holding up as strongly. That suggests pockets of softness. The Atlanta Fed growth tracker dropping from above 5% to around 3% also signals cooling momentum. So we are in this strange middle ground, not strong enough to justify runaway bullishness, not weak enough to justify panic, and that is why the term rotational volatility fits perfectly. After watching this interview, my biggest takeaway is this: the market is assuming resilience. It is assuming that earnings growth continues. It is assuming that AI capex remains strong. It is assuming that oil does not spiral out of control. As long as those assumptions hold, pullbacks are shallow and leadership rotates. But if one of those pillars cracks, especially energy or credit, the repricing could be sharper than many expect. Overall, I actually came away impressed by how disciplined the market reaction has been. No emotional selling, no disorderly credit stress, no dollar crisis. That tells me liquidity is still strong and institutional players are staying engaged. And when companies like Nvidia, Apple, Microsoft, and Alphabet are acting as stabilizers, it reinforces the idea that we are still in a structurally bullish phase driven by technology and capital investment, even if the path is choppy. So if you are watching this and wondering what it all means, here is my summary. The market is not ignoring risk, it is absorbing it, it is rotating around it, and it is betting that growth, especially AI-driven growth, remains intact. For now, that bet is working. The real question is how long those assumptions can hold, and that is what we will all be watching in the weeks ahead. Now let's jump into the 3 oversold stocks set for a comeback. Let's start with the first company. Booking Holdings, ticker symbol BKNG, is one of the most dominant digital travel platforms in the world. When you think about how people book hotels, flights, rental cars, and vacation packages online, this company sits right at the center of that ecosystem. It operates globally, connects millions of travelers with millions of properties, and processes an enormous volume of transactions every single day. Before we talk about numbers, we need to talk about why this business matters. Travel is not a fad. It is not cyclical in the way that a single product trend is cyclical. Travel is deeply tied to human behavior. People travel for business, people travel for family, people travel for leisure. As global incomes rise and emerging markets expand their middle class, travel demand expands alongside it. That structural tailwind is not going away. Booking has built a platform that benefits from scale effects. The more properties it lists, the more travelers it attracts. The more travelers it attracts, the more properties want to list. That two-sided marketplace creates a powerful network effect. It becomes increasingly difficult for smaller competitors to replicate that density of inventory and traffic. Another important factor is asset-light economics. Booking does not own the hotels. It does not own the planes. It does not carry heavy physical inventory on its balance sheet. Instead, it takes a commission on transactions. That means high margins and strong free cash flow when travel demand is healthy. Now here is where the oversold argument comes in. Despite strong long-term travel demand, the stock has experienced periods of pressure due to macro fears. Investors worry about recession risk. They worry about consumer spending slowdowns. They worry about geopolitical instability affecting cross-border travel. When those headlines intensify, travel stocks often get sold first. But the key question is this: is the underlying business deteriorating, or is the market simply pricing in short-term uncertainty? Another important factor is alternative accommodations. Booking has expanded aggressively into vacation rentals and non-hotel listings. This broadens its total addressable market and allows it to compete across different price tiers. Free cash flow remains robust. Strong cash generation enables share repurchases and strategic investments in technology. That financial flexibility becomes a significant advantage during volatile markets. From a valuation perspective, when a company with durable earnings power trades below its historical average multiple due to macro fear, long-term investors should pay attention. Oversold does not mean structurally impaired. It often means sentiment has overshot reality. Booking also continues investing in artificial intelligence to improve search relevance, pricing optimization, and customer matching. These enhancements increase conversion rates and improve customer retention. Over time, that deepens its competitive moat. Risks exist. A sharp and prolonged global downturn could slow booking growth. Geopolitical tensions could temporarily impact international travel flows. But history shows that travel demand rebounds. Consumers may delay trips, but they do not eliminate them permanently. In my view, booking represents a high-quality compounder that the market has temporarily discounted. The business fundamentals remain intact, and the long-term growth drivers are still in place. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. This video is brought to you by Value Stocks Investing Master Course. If you are looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's transition into the second company. Brown & Brown, ticker symbol BRO, operates in the insurance brokerage industry. This may not sound exciting at first, but it is one of the most consistent long-term wealth-creating business models in the market. Insurance brokerage is fundamentally different from insurance underwriting. Brown & Brown does not assume policy risk. Instead, it acts as an intermediary between clients and insurance carriers. It earns commissions and service fees for placing and managing insurance coverage. Why is that important? Insurance is essential. Businesses require property, liability, and employee coverage regardless of economic conditions. Individuals must insure homes and vehicles. That creates recurring demand that is relatively stable across cycles. Brown & Brown has built its growth model around disciplined acquisitions combined with organic expansion. It acquires smaller regional brokerages and integrates them into its network while preserving local relationships. This decentralized structure allows entrepreneurial leadership to continue operating effectively. The roll-up strategy has fueled consistent revenue growth. Smaller firms gain access to improved technology, expanded carrier relationships, and cross-selling opportunities. Brown & Brown gains additional revenue streams and geographic diversification. Commission revenue often benefits when insurance premiums rise because commissions are typically calculated as a percentage of premium value. In periods of inflation or tightening underwriting markets, brokers can see natural revenue tailwinds. Financially, Brown & Brown has delivered steady revenue increases and strong margin performance. The company generates reliable operating cash flow, which supports ongoing acquisitions without excessive leverage. The stock can experience temporary pressure during broader market rotations, especially when investors chase higher growth sectors. However, the underlying business continues compounding. Brown & Brown represents a different type of oversold opportunity compared to booking. It is not cyclical travel demand. It is a steady recurring revenue platform that quietly builds value over time. This sets up an interesting contrast between the first two companies. One benefits from global travel expansion and digital network effects. The other benefits from recurring insurance demand and disciplined capital allocation. When you analyze an insurance brokerage like Brown & Brown, you are not looking for explosive revenue spikes. You are looking for durability, consistency, and intelligent capital allocation, and that is exactly what this company has delivered over time. One of the most important advantages Brown & Brown has built is scale combined with decentralization. Many industries consolidate over time, but insurance brokerage is still highly fragmented. There are thousands of smaller regional players. Brown & Brown has used this fragmentation as an opportunity. Instead of trying to dominate through central control, the company allows acquired firms to maintain local leadership and client relationships. That preserves trust, which is critical in insurance. At the same time, those firms benefit from the broader platform's negotiating power with carriers, access to specialty products, and improved operational support. This model creates a powerful feedback loop. Strong cash flow funds acquisitions. Acquisitions expand revenue and scale. Greater scale improves margins and negotiating leverage. Improved margins increase cash flow. That compounding cycle is not dependent on a single macro event. It is embedded in the structure of the business. Financially, Brown & Brown has demonstrated consistent organic growth combined with acquisition-driven expansion. Revenue growth has been supported by strong client retention rates. Insurance brokerage is relationship-driven, and switching brokers is not frictionless. That stickiness protects recurring revenue streams. Another key factor is operating margin stability. Because the company earns commissions rather than taking underwriting risk, earnings volatility tends to be lower than that of insurance carriers. Brown & Brown does not have to worry about catastrophic claims impacting its balance sheet. Its role is advisory and intermediary, which creates a more predictable earnings profile. Balance sheet discipline is also critical. The company has historically maintained reasonable leverage levels relative to cash flow. That allows it to pursue acquisitions without jeopardizing financial stability. In volatile markets, disciplined leverage becomes a competitive advantage because weaker players may struggle to finance growth. Now let's talk about why this stock might be considered oversold. When markets rotate aggressively toward high growth or technology narratives, steady compounders can be temporarily overlooked. Additionally, when interest rates fluctuate, financial-related stocks can experience multiple compression even if their earnings outlook remains intact. However, the underlying insurance demand environment remains strong. Businesses still need coverage, individuals still need protection, and in periods where insurance premiums rise due to industry conditions, brokers often benefit through higher commission revenue. From a long-term perspective, Brown & Brown is positioned to continue consolidating a fragmented market. The total addressable market remains large, the company's acquisition pipeline remains active, and its decentralized operating culture continues to attract sellers who want to preserve their legacy while gaining scale advantages. If you are building a portfolio focused on durable cash flow and disciplined growth, this type of business deserves attention when valuation becomes attractive. Now let's move to the third company, which represents a very different type of opportunity. 𝗗𝗏𝗧, ticker symbol CNXC, operates in the customer experience and business process outsourcing space. At first glance, this industry may not generate excitement, but if you look closely, you will see that 𝗗𝗏𝗧 plays a central role in how global enterprises manage customer interactions across digital platforms. Before we get into valuation or recent performance, we need to understand the strategic relevance of this business. Companies today compete not only on product quality, but also on customer experience. Customer support, technical assistance, digital engagement, and omnichannel communication have become critical differentiators. As enterprises expand globally and digital channels multiply, managing these interactions internally becomes complex and expensive. 𝗗𝗏𝗧 provides outsourced solutions that allow enterprises to handle customer service, sales support, technical support, and back-office functions efficiently. It operates across numerous industries and geographic regions. Its scale allows it to provide multilingual support and advanced technology integration. One of the biggest shifts in recent years has been the integration of automation and artificial intelligence into customer engagement platforms. 𝗗𝗏𝗧 has been investing in digital tools and analytics to improve efficiency and performance for its clients. This is not simply call center outsourcing, it is increasingly technology-enabled customer experience management. Now let's address why CNXC has been under pressure. Business process outsourcing companies can face cyclical concerns. When economic growth slows, investors may worry that corporate clients will reduce discretionary spending on external services. Additionally, integration risks following acquisitions can create uncertainty. 𝗗𝗏𝗧 has completed significant acquisitions to expand its capabilities and global footprint. Large integrations can temporarily pressure margins as systems and cultures are aligned. Investors sometimes react negatively during these transition periods. However, the long-term thesis centers on scale, diversification, and digital transformation. 𝗗𝗏𝗧 serves large enterprise clients across industries, reducing dependence on any single sector. Its geographic diversification spreads risk across regions. From a financial standpoint, revenue remains substantial, and the company generates meaningful operating cash flow. Debt levels associated with acquisitions are being managed through disciplined capital allocation and earnings generation. The market may be pricing in near-term integration risk and macro uncertainty, but if management successfully integrates acquired operations and improves margins over time, the earnings power of the combined entity could be significantly higher than current sentiment implies. Another important factor is client stickiness. Large enterprises do not frequently switch outsourcing partners once operations are integrated. Transitioning customer service infrastructure is complex and costly. That creates switching costs and recurring revenue visibility. 𝗗𝗏𝗧 is also positioned to benefit from companies seeking cost efficiency. In economic slowdowns, outsourcing can become more attractive as firms look to reduce internal overhead and improve productivity. That dynamic can partially offset cyclical pressure. When you look at valuation relative to long-term earnings potential, oversold conditions can create asymmetric setups. If the market is overly focused on short-term integration challenges while ignoring structural demand for customer experience management, patient investors could benefit. Now that we have reviewed all three companies, it is time to bring the analysis together and look at how these oversold stocks could fit into a long-term investing strategy. Booking, ticker BKNG, Brown & Brown, ticker BRO, and 𝗗𝗏𝗧, ticker CNXC, are very different businesses, yet they share a common thread. They each benefit from structural advantages that allow them to compound earnings over time even when the broader market is volatile. Let's start by comparing their competitive advantages. Booking sits at the center of global travel commerce with a two-sided marketplace that is extremely hard to replicate. Its network effects strengthen as more properties and travelers participate, creating a virtuous cycle. That scale and reach are not easily duplicated by new entrants. Brown & Brown, on the other hand, has a moat built on recurring demand and disciplined acquisitions. Its decentralized structure allows acquired brokerages to maintain client relationships while benefiting from scale and better carrier access. This combination of autonomy and platform advantage is rare and difficult for competitors to copy. 𝗗𝗏𝗧 benefits from high switching costs and global client reach. Once enterprise operations are integrated into its systems, clients rarely switch providers. Adding technology-enabled services, AI-driven analytics, and multilingual capabilities further strengthens its competitive positioning. Growth drivers for each company are also very different, but all are durable. Booking will continue to see structural tailwinds from rising global travel demand, increased digital penetration, and the expansion of alternative accommodations. Brown & Brown will see continued revenue growth from strategic acquisitions and a strong recurring client base, with commissions benefiting naturally from premium growth. Concentrix will benefit from enterprise clients increasingly outsourcing complex customer interactions and integrating digital technology to enhance efficiency. Each company's growth is tied to broad structural trends rather than short-term cycles, which is why long-term investors should pay attention. From a financial perspective, all three companies generate strong cash flow. Booking converts revenue into high free cash flow margins due to its asset-light model. Brown & Brown earns predictable recurring commissions while maintaining disciplined leverage to fund acquisitions. Concentrix generates cash from enterprise contracts and is investing strategically in technology to drive margin expansion over time. These cash flows not only fund growth but provide options for share buybacks, debt repayment, or reinvestment into the business, all of which support long-term shareholder value creation. It is important to also understand why these stocks are oversold. Market rotations, macro uncertainty, and short-term fears often create temporary mispricing. Travel stocks like Booking tend to get hit during economic anxiety or geopolitical tensions even if bookings remain strong. Brown & Brown can be overlooked when investors chase high-growth sectors. Concentrix experiences market skepticism during acquisitions or when integration costs impact near-term margins. These are examples of sentiment temporarily diverging from fundamentals. For patient investors, that divergence can be an opportunity rather than a warning. Risk management is critical when considering these types of investments. For Booking, a prolonged global downturn or severe restrictions on travel could temporarily reduce bookings and impact earnings. For Brown & Brown, risks include changes in regulatory frameworks, insurance premium fluctuations, or integration missteps with acquired brokerages. Concentrix faces the risk of slower adoption of outsourcing services or challenges in integrating acquisitions efficiently. Understanding these risks allows investors to weigh reward potential against downside scenarios and position capital accordingly. Now let's look at portfolio implications. These three companies provide diversification across sectors and business models. Booking gives exposure to global travel and digital marketplaces. Brown & Brown provides a stable, recurring revenue stream in financial services. Concentrix gives exposure to business process outsourcing with structural growth opportunities through technology. Combining these stocks in a portfolio can balance cyclical exposure, provide cash flow consistency, and capture upside when oversold conditions correct. Another factor to consider is valuation. Oversold stocks often trade below their intrinsic value due to short-term fears. When a high-quality business with durable cash flow is trading at a discount, patient investors have the potential to capture both capital appreciation and income generation through dividends or share buybacks. Booking, Brown & Brown, and Concentrix each have characteristics that allow investors to look beyond temporary volatility and focus on long-term earnings power. From a tactical perspective, it is helpful to monitor entry points. Investors can look for periods of market stress when these quality businesses may be sold off more than justified by fundamentals. This approach allows for accumulation at lower prices while maintaining a long-term view. The goal is not timing the market perfectly, but taking advantage of sentiment-driven opportunities to buy solid businesses below their intrinsic value. It is also worth noting that management quality plays a significant role in each of these companies. Booking has demonstrated disciplined capital allocation and investment in technology to maintain its competitive edge. Brown & Brown has proven its ability to acquire and integrate smaller brokerages while preserving client relationships. Concentrix is actively investing in digital capabilities to enhance operational efficiency and client value. Skilled management teams provide confidence that these businesses will navigate volatility effectively. In my personal view, these three oversold stocks illustrate the power of long-term investing. You are not chasing the latest trend. You are investing in businesses with proven models, strong moats, and the ability to compound earnings over time. Short-term market swings create anxiety for some investors, but for those who focus on quality and structural growth, these conditions can present opportunity. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Before we wrap up, I want to pose a question for you in the comments. Considering the long-term advantages of booking Brown & Brown and Concentrix, which company do you think has the strongest structural moat over the next decade? Do you believe network effects, recurring revenue, or high switching costs will drive the greatest returns? Leave your thoughts in the comments. To summarize, Booking, ticker BKNG, is a digital travel platform with network effects and global reach. Brown & Brown, ticker BRO, is a disciplined insurance brokerage with recurring revenue and acquisition-fueled growth. Concentrix, ticker CNXC, is a global customer experience and business process outsourcing leader investing in technology to enhance efficiency and client value. All three companies are temporarily oversold but have durable growth drivers and strong competitive positions. Investors looking to build wealth over time should focus on quality, cash flow, and structural advantages. These three companies exemplify those traits. They offer a combination of short-term market opportunity and long-term growth potential that is hard to ignore. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.